Ma'am Pat, and our lesson for today is financial liabilities, part 1. So we are dividing our discussion of financial liabilities into several parts, probably into 3 parts. And our learning outcome for this session are as follows. We will define liabilities and we will identify their essential characteristics. We will describe the nature of financial liabilities. So the focus of our discussion is still financial liabilities. Then we will cite the initial recognition criteria for financial liabilities. And we will apply such recognition criteria. Then we will go to specific financial liabilities. We will tackle the simplest during this session, accounts payable and notes payable. So we will illustrate initial recognition, measurement, and measurement after initial recognition, and presentation in the financial statements, as well as settlement of accounts payable and notes payable. Okay, so as defined in the IASB's conceptual framework under the chapter elements of financial statements, so this is the second element enumerated, liabilities. Liabilities are present obligation of an enterprise to transfer an economic resource as a result of past event. Therefore, these are the 3 essential characteristics of liabilities: present obligation, transfer of an economic resource, and result of past event. So, an obligation as defined in the liabilities as part of the definition of liabilities is a duty of an enterprise. And the enterprise has no practical ability to avoid such duty or such obligation. Such obligation must exist as of the reporting date. The reporting date is the date of the statement of financial position. That is the end of the reporting period. Therefore, the obligation must exist as of the end of the reporting period, and that the enterprise has no practical ability to avoid such obligation. How is the obligation settled? So what is that obligation? The obligation is to transfer an economic resource. That means that we will be giving up economic benefits. Therefore, the settlement will involve payment in cash or cash equivalent, transfer of other assets, provision of services. So we will render services in the future. Example is unearned income. So unearned income is a liability that is settled not by payment in cash, not by transfer of other assets, but by rendering our services in the future. Or we will replace that obligation with another obligation. Example is an account payable that is settled by issuing a promissory note. So the account payable is settled by a note payable. Or conversion into equity. This may be in the form of convertible debt. So convertible debt, meaning convertible liabilities or liabilities, may be settled by converting our creditors into shareholders. In some exceptional cases, liabilities are settled by condonation, meaning that we are being forgiven by our creditors, but this is exceptional. Now, the obligation existing as of the balance sheet date is a result of past event. Therefore, this past event arises either from a legal obligation or constructive obligation. Therefore, legal obligation and constructive obligation are what we call obligating events. So a legal obligation arises from a contract, not necessarily written, but most of the time written. So the mere acceptance of the delivery of goods from supplier accompanied by delivery receipt is a legal obligation because it arises from a contract between the supplier and the customer, and we are therefore the customer. Your obligation to your employees for any unpaid salaries is also a legal obligation. What about constructive obligation? So legal obligation arises from contracts. It arises also from provisions of law or any other operations of law. Whereas constructive obligation comes from public announcement made by an entity, or it may arise from public practices of the entity such that other enterprises or other entities are made to believe that because of these past practices, the entity will follow such past practice and will therefore give up an economic resource in the future. Examples of obligations arising from constructive obligation are bonuses that are announced by entities, let us say in a gathering of shareholders or enterprise employees. Therefore, if the management of the entity announces in an employees meeting that it will give, let us say, 5% of net income because of good performance of the entity, but that is not covered by a CBA, then such undistributed bonuses constitute constructive obligation. So it arises from a public announcement, or it may arise also from past practices. So if it is a practice of the entity over several periods of time that it is giving 14th month pay in addition to the 13th month pay, and that is not covered by a CBA, but rather that is just out of the generosity, continuous generosity of the management, then the 14th month pay that has not yet been distributed at the end of the year constitutes constructive obligation, and therefore that will be a basis for preparing an accrual of that unpaid bonuses. Okay, again, liabilities are present obligation of the enterprise. By present again, they must exist as of the balance sheet date, and the enterprise has no practical ability to avoid such obligation. And this obligation constitutes transfer of an economic resource, which may be settled by payment in cash, transfer of other assets, provision of services, replacement with another obligation, conversion into equity. And that obligation arises from past action of the entity. So your obligating event must be a past event already. It is a consummated transaction, or this one has happened already. This is the reason why estimated future losses of the entity, no matter how likely, are not recorded as accounting liabilities because there is no past event yet. We now focus on the topic itself, financial liabilities. So this is still governed by IFRS 9. In fact, this is already the fifth chapter in your volume 1, financial liabilities, because volume 1 of intermediate accounting focuses on IFRS 9 and the related standards. So these are all financial instruments. So in receivables and debt instruments wherein we are the holder, they are considered as financial assets of the holders. So we go now to the other party. We go to the issuer of the financial instrument. Hence, we are now recording financial liabilities. Therefore, financial liabilities are contractual obligations. So when we say contractual obligation, it arises from contract. Therefore, your obligating event is not one of a constructive obligation, but one of legal obligation. Not necessarily mandated by law, not provided for by law, but this is uh, provided for by a contract. Therefore, it arises from a contract, not necessarily written, but in most cases written. Okay, so this is a contractual obligation to pay in cash or another financial asset, to exchange with financial liabilities. So you are converting your financial liability, meaning your payable, into another payable. And that exchange will be potentially unfavorable to the entity. Or you are settling your financial liability in your own equity instruments, and the issuance of the equity instruments will be potentially unfavorable to the entity. However, rights, options, and warrants issued by an entity on a pro rata basis to existing shareholders to issue own shares of capital are not financial liabilities. So rights, these are your preemptive rights. So warrants that are issued as evidence of preemptive rights of the shareholders are not potentially unfavorable to the entity because exercise of the rights will mean uh, obtaining additional resources from our potential shareholders, and the equity of the potential shareholders will not be diluted, hence not unfavorable to the entity. Same is true with options. Options are given to executives or key officers of the entity to become shareholders of the entity, and granting of the options would be not potentially unfavorable to the entity. Same is true with warrants. So if warrants are issued to make some other financial instruments attractive, then this is not potentially unfavorable to the entity. Hence, rights, options, and warrants, although they are financial instruments, they do not constitute financial liabilities because soon the exercise of rights, options, and warrants will increase our capital stock, and hence rights, options, and warrants are considered as part of shareholders' equity. So we go to the initial recognition. So the initial recognition principle for financial liabilities is the same initial recognition principle for financial assets. That is, financial instruments, whether assets or liabilities, are recognized when and only when the entity becomes a party to the contractual provisions of the instrument. Therefore, if we are the holder of the financial instrument, that means we have a financial asset. However, the other party, which is the issuer, has a financial liability. Hence, a financial liability will only be recognized when the entity becomes a party to the contractual provisions of the instrument, meaning we are the issuer in general terms of the financial instrument, or we are a party to that financial instrument. That being a party, we are obliged to transfer an economic resource at a future date. So at what amount do we recognize financial liability? So financial liability is initially recognized at fair value, which is the transaction price. For financial liabilities that are subsequently measured at amortized cost, meaning there is either a stated rate or an imputed rate, such that there is an effective rate of interest, and we consider that effective interest in the computation of the amortized cost of the instrument, then transaction cost is considered in initial measurement. Therefore, only those financial liabilities measured at fair value will be recognized at transaction price. For financial liabilities that will be subsequently measured at amortized cost, your initial measurement will be the transaction price minus the cost incurred to receive whatever is considered as a result of incurring the liability. For example, if we incur a liability because of borrowings, so nangutang tayo, so the initial proceed is the borrowing proceed, but out of the borrowing proceed, we pay for some transaction costs. Therefore, your financial liability will be initially measured at the initial proceeds minus the borrowing transaction cost that is incurred by the entity, hence at the net proceeds. We now go to specific financial liabilities. We go to the most basic, and the most basic, of course, is accounts payable. Accounts payable are trade liabilities, meaning these arise from purchase of goods or services that are consumed or to be sold by the entity in the normal conduct of business. So, assuming that there is no transaction cost, the accounts payable must be initially measured at the transaction price. There are two methods of accounting for accounts payable. The more popular is the gross method, and this is the one that was discussed with you extensively in your senior high school or in your FAR, financial accounting and reporting, your first accounting course in your accounting program. Under the gross method, accounts payable is recorded without deducting the cash discount offered. So although it is initially recorded at the gross amount, that gross amount will later be adjusted before we reach the balance sheet date. The cash discount, so cash discount when this is related to purchases is otherwise known as purchase discount. So the purchase discount is recorded as a deduction from cost or expense, and your cost or expense is the purchases account. Therefore, the purchase discount as a deduction from purchases is recorded when discount is taken, meaning when we avail of the discount and we pay within the discount period. So do we have year-end adjustment? Yes, we have. Year-end adjustment is made for accounts settled in the subsequent period within the discount period. So before we discuss the net, let us have some illustrative exercise for the gross method. So on December 10, we purchased goods from X, 100 to over 10 and over 30. Therefore, our entry is to debit purchases, 100, and credit accounts payable, 100. So we do not deduct yet the 2% discount available. 2% is 2 pesos in this case. On December 14, we purchased goods from Y, 100 to over 10 and over 30, hence the same journal entry. We debit purchases 100 and credit accounts payable, your subsidiary ledger is Y, 100. Assume that on December 24, we paid Y in full. So instead of paying X first, because we have only available cash balance, we opted therefore to pay Y because paying Y would mean that we will still avail of the 2% discount. Whereas if we pay X on December 24, the amount that will be paid will be 100. Therefore, we will be able to save 2. So we are paying Y, and this is the last day to avail of the discount. We debit therefore accounts payable Y, 100, credit purchase discount 2, and credit cash 98. Therefore, we record the cash discount when the cash discount is availed off by us. So when we pay within the discount period, that is the time that we record the purchase discount. And the purchase discount is considered as deduction from purchases. Therefore, if there are no more intervening transactions, and these are the only transactions relating to purchases, we have total purchases of 200 minus purchase discount of 2. Therefore, we have a total of 198 in our cost of goods sold. So the account of X is left unpaid by year end. So what would be the amortized cost of our account payable with X? Because the last day to avail of the discount with X is December 20 and is still as of December 31, it remains unpaid, then our liability to X is still 100. It's not 98, but it is 100. And therefore, no adjustment is necessary at December 31. So when we pay during the subsequent period, what will be our entry? We debit accounts payable 100 and credit cash 100. And therefore, the discount that is lost is actually embedded in the account purchases. Your purchases here should have been 98 only. The 2 pesos discount that was lost was embedded in the account purchases. And therefore, the gross method failed to allocate that 2 as finance cost. Actually, that is a finance cost, meaning an expenditure that was incurred by the company because it failed to pay within the discount period. But that finance cost is not separately presented. Okay, let us change some more information, but it's still on the gross method. Again, there is no adjustment here because at year end, the discount period has already expired and therefore your accounts payable remains at gross amount. In this case, that is 100. Okay, let us have second case. Again, on December 14, we purchased goods from Y, 100 to over 10 and over 30. Hence, our entry debit purchases 100, credit accounts payable Y 100. So we do not deduct yet the 2. On December 24, we paid Y in full. We debit therefore accounts payable Y 100, credit purchase discount 2, and credit cash 98 because we are still entitled to discount. On December 26, we purchased goods from X, 100 to over 10 and over 30. We debit therefore purchases 100 and credit accounts payable 100. So assuming that there are no intervening transactions and that the account of X remains unpaid at year end, how much really is your liability at December 31? Meaning, if at December 31, we decided to pay X, how much is our payable to X? Our payable is actually 98 because from December 26 to December 31 is just 5 days, and 5 days is still within the first 10 days from the date of purchase, and therefore we are still entitled to discount. If assuming that we paid the account with X on January 5, then our entry would be to debit accounts payable 100 and credit purchase discount 2, credit cash 98. We are paying 98 because we are entitled still to that discount because January 5 is exactly the 10th day from the date of the invoice. And therefore, please take note that the purchases had been recorded in this reporting period. Assuming this is 2020, then the purchases had been recorded in 2020, but the related purchase discount, which is a deduction from the purchases, is recorded in 2021. Hence, there is no proper matching. The cost was recorded in 2020, but the deduction from the related cost is recorded in 2021. Matching therefore is violated. Other than that, if no adjusting entry is made, your accounts payable at December 31 is measured at 100. But if we are to pay on December 31, your liability to X is not actually 100 but only 98, which is the amount that was actually paid subsequently. Hence, an adjusting entry has to be made at year end to record such purchase discount potentially to be availed of in the subsequent period. Your entry is to debit allowance for purchase discount, which is a real account. This one is real account. Sinabing real, its balance will be carried forward in the subsequent reporting period. Credit purchase discount, this is a nominal account, meaning its balance will be closed at the end of the year. And therefore, through this entry, we recorded a deduction from accounts payable. Allowance for purchase discount is a deduction from accounts payable to arrive at the amortized cost of the accounts payable. Hence, your accounts payable by year end is 100, this one, minus the debit, because this is a liability, allowance for purchase discount of 2. Therefore, your amortized cost is 98, which is your real liability to X. Your purchase discount is recorded also during the same year that we recorded purchases. Now, this entry is subject to reversal at January 1 of the succeeding year. So, for lack of space, I did not prepare anymore the reversing entry. But the reversing entry here is to debit, the exact reversal, debit purchase discount 2, credit allowance for purchase discount 2. By reversing, therefore, your allowance for purchase discount, which has a previous balance debit of 2, is now brought to 0 at January 1 after the reversing entry. Your purchase discount is a nominal account. Therefore, at the end of previous year, it has brought to 0. Therefore, when you reverse on January 1 and you debited purchase discount, it results in an abnormal debit balance of 2. But that is just temporary. So after reversing, your purchase discount as a normal balance of debit, abnormal balance of debit 2. However, on January 5, when we paid X in full, our entry is to debit accounts payable 100 because that is the amount that was originally recorded. We prepare the usual entry to record payment within the discount period, credit purchase discount 2, and credit cash 98. Therefore, after preparing this entry, sabi natin kanina, your purchase discount after reversing has an abnormal debit balance of 2. But because of the subsequent credit, that abnormal balance has been brought to 0. Hence, there is no purchase discount in effect that was recorded in January. Why no purchase discount? Because that purchase discount is related to a purchase that was made last year. And therefore, the accompanying purchase discount must likewise be recorded last year. We now go to the net method. We go back to the previous slide. Under the net method, accounts payable is recorded net of cash discount, meaning we deduct immediately any cash discount that is offered by the supplier. The cash discount is recorded when it is not taken, and the cash discount is recorded as a finance cost. A year-end adjustment is made for accounts whose discount period already lapsed. Okay, and therefore, we proceed again to the illustrative cases under the net. So, under the net. Again, on December 10, we purchased goods from X, 100, to over 10 and over 30. And therefore, because we are using the net, we deduct immediately the 2%. We debit purchases 98, credit accounts payable 98. So theoretically, this is superior than the gross method because this records the accounts payable at the fair value, and the fair value is 98. The fair value is the transaction price. If we are paying in cash for the goods that are purchased on this date, we are paying only 98. On December 14, we purchased goods from Y, 100, to over 10 and over 30. Hence, we debit purchases 98, credit accounts payable 98. On December 24, we paid Y in full. And therefore, this is the 10th day from the date we purchase from Y. And therefore, we are entitled to discount. Hence, the amount that will be paid to Y will still be 98. Hence, our entry, debit accounts payable, Y, 98, credit cash, 98. So, assuming that there are no intervening transactions, that means that by December 31, the account with X is still outstanding. We recorded the accounts payable to X at 98. The last day to avail of the discount is December 20. At December 31, it remains unpaid. Therefore, your liability to X is now increased to 100. Sabi natin kanina, under the net method, we prepare year-end adjustment if by year-end, the account has already lost its opportunity to avail of the discount. And therefore, we are preparing this adjusting entry. From 98 to 100, the accounts payable must be increased by 2. Hence, we credit accounts payable 2. And we are recording a finance cost. That finance cost is discounts loss. We debit discounts loss to credit accounts payable 2. And therefore, under the net method, our total purchases amounted to 196,000. That is the total net purchases from X and Y, 196. We present a separate expense account under finance cost of 2. That finance cost actually represents faithfully the situation of the entity. That is, it incurs additional expense of 2 because it fails to avail of the discount offered by the supplier. Therefore, it is a credit-related expenditure. As far as accounts payable, your amortized cost that will be presented in the statement of financial position will be 100. That is the amount originally recorded, which is 98 plus the discount that was lost. In effect, that is interest of 2. So the total is 100. Therefore, when we pay in the subsequent period, because the account with X has been increased already to 100, your entry is to debit accounts payable 100 and credit cash for 100. Okay, let us change some information. Again, on December 14 is still on the net method. On December 14, we purchased goods from Y, 100 to 10 and 30. Hence, our entry debit purchases 98, credit accounts payable 98. On December 24, we paid Y in full. Therefore, the amount to be paid is net of the discount, debit accounts payable 98, credit cash 98. On December 26, we purchased goods from X, 100, debit purchases, credit accounts payable 98. Assuming that this remains unpaid at year end, How much is your liability to X? Our liability stays at 98 because from December 26 to December 31 is only 5 days. And therefore, your liability will be settled, assuming it will be settled by December 31, with cash payment of 98. Hence, because our accounts payable is valued at 98, no adjusting entry is necessary at year-end. Under the net method, you record an adjustment only when the discount period has lapsed. We will be recording additional finance costs. And therefore, by January 5, we paid X in full with debit accounts payable 98, credit cash 98. Your possible question here is, if in January we paid beyond the discount period, what will be our entry? Your entry will be to debit accounts payable 98, debit discounts lost 2, and credit cash 100. The discounts lost will be recorded in January because that is a credit-related expenditure, which is synonymous to interest expense, and interest expense accrues with the passage of time, and therefore it is proper that we record it also in January, provided that by December 31, the discount period has not yet lapsed. We now proceed to notes payable. So, generally, it is a written promise to pay sum of money to another entity at the terminable future date. It may also be an order addressed to another person to pay another entity. So, three-party note. Therefore, it's a draft, an order by one entity addressed to another to pay a third party. Okay, so notes payable may be written in a form that may be interest-bearing or non-interest-bearing. So for interest-bearing note, it is written in a form wherein the face value is the present value at the date of the issue. The interest rate, therefore, is stated on the face of the note. Such interest may be a fixed amount or it may be expressed in terms of rate. Whereas a non-interest bearing note is one wherein the face value is already the maturity value. The maturity value, therefore, already includes the imputed interest. Therefore, if it is interest-bearing, the amount that is presented on the face of the note as the face value is the value of the note upon issuance. Whereas if it is non-interest-bearing, the face value stated on the note will be the amount of the note at the date of maturity. And of course, the amount of the note at the date of maturity is actually higher than the amount of the note at the date of its issuance because of the imputed interest. Therefore, for non-interest bearing note, the present value is the maturity value minus the imputed interest. So, do they differ in form? Yes, they differ in form. Do they differ in substance? We will see a little later. Okay, so let us take this as an example. On October 1, 2020, a machine with a cash price of 100,000 was acquired by issuing a 1 year. So for simplicity, we will limit the term of the note to 1 year. with effective rate of 6%. And therefore, if the cash price of the machine is 100,000 and the imputed interest and the effective interest is 6%, that means after 1 year, the maturity value of the note will be 106,000, adding 6,000 to the present value. Therefore, what is the note's carrying value at December 31, 2020? Assuming the note issued is letter A, interest bearing, and letter B, non-interest bearing. We will provide entries including adjustments. And therefore, for interest bearing, this will be our entries. On October 1, 2020, we will be recognizing the equipment, and the equipment will be recognized at its equivalent cash price, which is 100,000. The note is written wherein the face value is its present value, which is the equipment's equivalent cash price. Hence, we credit notes payable for 100,000. However, assuming that the end of the reporting period is December 31, interest accrues with the passage of time. So from October 1 to December 31, we will compute interest. The interest for 1 year is 6,000. So 6,000 times number of months that lapse from October 1 to December 31, that's 3/12. That means, therefore, it is 1,500. So we debit interest expense 1,500, credit interest payable for 1,500. Therefore, what is the amortized cost of the note? The carrying value at December 31 of the note is the ledger balance, which is notes payable of 100,000 plus the interest payable of 1,500. Total amount that will be presented on the statement of financial position relating to the note is 101,500. So if we are to prepare a properly classified statement of financial position, your current liabilities will include notes payable inclusive of accrued interest amounting to 101,500. Therefore, at maturity date of the note, how much shall we pay? We are paying a total of 106,000, and therefore our recognition entry is to cancel the ledger balance of the notes payable, 100,000. Cancel the previously recorded interest payable at December 31, 15, and take up the additional interest expense for the period January 1 to September 30, 2021. Therefore, that is 6,000 times the remaining 9 months over 12 months. Therefore, 4,500. Therefore, your interest expense of 6,000 is actually incurred partly in 2020, 1,500, and partly in 2021, 4,500. Now, if the note is non-interest bearing, what will be our entries and what will be the face value of the note? Sabi natin kanina, the face value of the note is its maturity value, and therefore, if the equivalent cash price of the equipment is 100,000 and there is an effective interest of 6,000, that is 6% times 100, the maturity value of the note will be 106. Hence, its face value will be 106,000, but its actual value come its date of issuance is only 100, and therefore the equipment will still be recorded at the equivalent cash price of 100,000. To bring, therefore, that recorded notes payable to its present value, we will be creating a contra liability account, which is discount on notes payable. Hence, we record discount on notes payable 6,000. The discount on notes payable is a contra liability account on October 1, 2020. Ledger balance of notes payable is 106, reduced by the discount on notes payable of 6,000. Hence, its amortized cost at the date of initial recognition is its fair value of 100,000. So on December 31, we will amortize the discount. This discount is for 1 year. Actually, this is the interest for 1 year. So 6,000 times Number of months from October 1 to December 31, 3 over 12, that is 1.5. So we record the same interest expense that we previously recorded when the note was interest bearing, 1,500, and we are reducing the balance of the discount on notes payable, 1,500. And therefore, what is the carrying value of the notes at December 31? If we are to use our ledger balances, we have notes payable of 106,000 minus the remaining unamortized discount on notes payable. We started with 6,000 reduced by 1,500. So the remaining balance of discount is 4,500. Hence, the amortized cost is also 101,500. Please take note that the amortized cost of the interest-bearing note is also 101,500. Hence, in the statement of financial position, the non-interest-bearing note will still be presented as part of current liabilities. So this is notes payable net of discount, which will be presented at 101,500. So basically, it's the same. So come September 30, 2021, therefore on maturity date of the note, we will be paying now a total of 106,000, which is the maturity value of the note. So your entry will be to debit notes payable 106,000. We now record the additional interest expense that runs from January 1 to September 30, 2021. That's the remaining 9 over 12 of 6,000. So that is 4,500. We recognize the discount because we are recognizing also the notes payable, and therefore the remaining accessories will have to be brought to zero also, 4,500, and credit cash for 106,000. Therefore, after September 30, your notes payable has a zero balance already. And therefore, if we are to analyze what's the difference between interest-bearing and non-interest-bearing, they differ in form only, but they are the same in substance. If it is interest-bearing, we start with the face value equal to the present value, and therefore that's 100,000. However, this is our balance sheet date. This is our reporting date, December 31, 2020. Hence, from October 1, 2020 to December 31, 2020, we will be increasing our amortized cost by 1,500. Hence, we have a total of 101,500 as its amortized cost. Whereas if it is non-interest-bearing note, our ledger balance is started with notes payable equal to maturity value of 106. However, initially, we set up a discount equivalent to 6,000 as of October 1. But this 6,000 will have to be apportioned as the months pass by, and therefore as of December 31, 2020, part of the discount is amortized. So 6,000 minus the amortized discount corresponding to this period, which is 1,500. Hence, the remaining balance of the discount from December 31, 2020 to September 30, 2021 is 4,500. And this 4,500 will be deducted from the ledger balance of 106,000 to arrive at the carrying value of the note. And therefore, on December 31, 2020, your carrying value is 106 minus this remaining amount of 4,500, and therefore that is still 101,500. Hence, the value of the note as of December 31, 2020 in our example is 101,500 regardless of whether the note that was issued is interest-bearing or non-interest-bearing. In conclusion, therefore, interest-bearing and non-interest-bearing only differ in form. However, when you are to account for them following faithful representation at balance sheet date, you have to arrive at the same carrying amount, which is the amortized cost. And therefore, in the financial statements of December 31, again, for interest bearing, you have notes payable of 100,000. plus interest payable of 1,500. So carrying value is 101,500. However, for non-interest bearing, although your notes payable is initially set up at 106, the discount on notes payable will have to be deducted. Hence, the carrying amount, which is the amortized cost, is also 101,500. So whether it's interest bearing or non-interest bearing, the amount that will be presented in the statement of financial position will still be the same amortized cost of 101,500 in our example. And therefore, what principle is applied? We apply the fundamental qualitative characteristic of accounting information, and that one is representational faithfulness, meaning what is the actual intention of the party is actually communicated in our ledger balances, in our financial statements. And we emphasize substance over form. Although interest-bearing and non-interest-bearing differ in form, actually they are one in substance. Hence, we present the same amount of amortized costs. And therefore, your assignment, actually that's for tomorrow, for next meeting. Again, based on your textbook Intermediate Accounting Volume 1, whether you are using 2019 edition or 2020 edition, you are to answer 5-1 to 5-5. There is no need for you to submit that to me. You have to be ready for our discussion. Again, as a summary of learning outcomes, we have defined liabilities based on the definition of the concept in the conceptual framework. We describe the essential characteristics of the liabilities. We focus on the nature of the financial liabilities. We cited the initial recognition criteria for financial liabilities, and we have accounted for accounts payable and notes payable. We completed a cycle, initial recognition and measurement after initial recognition, presentation in the financial statements, as well as the recognition. And therefore, that's all for this session. Again, this is Ma'am Pat saying I'll see you during our synchronous presentation. Thank you.